Do you remember when COVID led to shortages, a stockpiling of toilet paper, and then when it all ended, a surge in inflation? It's only 3 years ago, though it does feel like a lot longer. But US retailers could start to see looming shortages, with extremely high tariffs on China, causing a sharp drop in imports from China to the US. According to Vision, overall shipping traffic fell by 64% week starting April the 7th, and this fall continued in the next week, causing Chinese imports to be 45% down year on year. And it's led to major retailers warning of empty shelves of goods, which usually come from China. Toys, electronics, clothes are likely to be particularly affected. And in a bizarre recreation of COVID, many ships are now stuck in China rather than sailing to the United States. Hapag Lloyd say that bookings from the US to China are down by around a third, causing many US ports to be much more empty than usual. It takes about 2 or 3 weeks for a container ship to travel from China to the United States, which means that shortages won't appear for a while. But it also means that even when tariffs are reduced, it could take a few weeks to restock shelves and get supply chains going again. Toy retailers are particularly worried, as toys almost exclusively come from China. Over 80% of companies are cancelling orders, and 45% say they are at risk of going out of business over the next few weeks. And it's not just retailers. Soybean farmers, beef farmers have been hit by retaliatory tariffs from China. But arguably the biggest losers could be those in the logistic industry, lorry drivers and port workers, who will be adversely affected by a trade freeze. Now, the US imports over $500 billion of goods from China, and in the short term at least, it will be very hard to replace that. American consumers have got used to cheap goods from China, and these tariffs will be a real shock. Temu, which has become popular amongst American consumers, export goods directly from China to US buyers. But now it's already starting to significantly increase prices, more than a 100% rise. So this could be the end of an era of really cheap American consumer goods. Who wants to buy an iPhone costing $2,500? But inflation is not just about the impact of higher tariffs. There could also be knock-on effects. Going back to COVID inflation, why did inflation surge so much at the end of lockdown? Probably the most important factor was that after COVID, ships were often in the wrong part of the world, stuck on the other side of a globe. And when suppressed demand surged at the end of lockdown, it was really hard for shipping to keep up with this increased demand. And this led to a surge in the price of shipping and transporting goods, and that started the inflationary price rises. And this unprecedented level of tariffs has led to a disruption of trade between China and the US, and it risks creating new sources of friction in shipping and trade. It's causing firms to try to stockpile for fear of shortages. But these swings in demand and supply are very likely to create an opportunity for firms to put up prices. Now, another factor behind the COVID inflation is that when costs started to rise, many firms took it as an opportunity to pass on even more to consumers. Basically, firms thought if costs are going up 14%, why not round it up to 20%? Who's going to know? You could call it greed inflation. Volatile swings in inflation definitely makes it much easier for firms to push up prices. And this is why corporate profitability in the US increased so much during the COVID era. Now, another factor in the COVID inflation was that in the US at least, there was a lot of monetary and fiscal stimulus, more quantitative easing, and then the stimulus checks. This increased demand, which only added to the inflationary fuel, which caused inflation to go up to 10%. Now today, that robust demand is probably not really there. Many American households have been really squeezed by cost of living, relatively limited growth in real wages. The US saving ratio has fallen really quite a lot. Many households are getting by on day-to-day loans. Indebtedness has increased. By the way, this contrasts with the UK, where the saving ratio has increased, a reflection of long-term pessimism in the UK. But in recent years, US consumers have actually been quite happy to spend a lot, and this has contributed to high growth. But the tariff uncertainty, higher prices, has really caused a dent in consumer confidence. Consumer expectations of inflation have gone up by quite a lot. And unfortunately, many households are living on the edge, using loans to pay for even basic household groceries. Now, the sight of empty shelves will undoubtedly be splashed around social media and the traditional media. It's a kind of thing that can get easily exaggerated. But in economics, you should never underestimate the importance of confidence and animal spirits. Whether fair or not, the trade war is really denting consumer and business confidence. Now, it's worth bearing in mind it's not all bad with the US economy. In recent years, US growth and productivity has actually been much greater than the European Union and the UK. The Resolution Foundation produced an interesting report why US productivity is so much better than the UK. Now, that isn't all going to suddenly evaporate, but the US really does have a two-speed economy. The share of income going to small business and employees has steadily fallen and fallen quite sharply in recent years. By contrast, the share of income going to corporate profit and rental income has increased quite a lot. In fact, if you want to understand what's been going on with the US economy in recent decades, this graph goes a good way to explaining what's been happening. Yet even the conservative-based IMF have downgraded growth forecasts for the US this year, and perhaps they are assuming some kind of resolution to the trade war, because if it's not, there's plenty more who argue that it really would push the US into recession. Now, back to inflation. What about the role of the Federal Reserve? Many blame money creation in 2022 for causing the inflationary surge. This is part of the story. It is worth bearing in mind many countries had the same inflation rate without any monetary or fiscal stimulus, although it was cost-push inflation. But the stimulus checks undoubtedly did fuel some of the US inflation. Studies suggest around a quarter of it. But the point is, what about this time? Now, the Federal Reserve is under pressure to cut interest rates to reduce borrowing costs and support the economy. But at the same time, unlike the 2010s, when inflation was low, inflation is likely to rise. Furthermore, the dollar has been very weak this year, fallen by 10%, worse even than, say, 1973 during the first oil crisis. So a big reduction in interest rates at the same time as inflation going up could make markets worried that the Federal Reserve is losing their commitment to low inflation. And this would really come at a bad time and putting more downward pressure on the dollar. A falling dollar and rising bond yields really does come at a bad time for the US. US debt is soaring. The deficit was 7% as a share of GDP last year, even despite the economy doing relatively well. And it's likely to increase even more because of more tax cuts. And for all the talk of tariff revenue replacing income tax revenue, this is unlikely to occur. Tariff revenue is still very small as a share of overall tax take. Don't forget, if you have very high tariffs, the good doesn't get imported at all. 145% of zero sales is still not zero income. Now, already foreign investors are showing less appetite for buying US assets like US treasuries. But if US debt is set to soar, then foreign purchases of US treasuries will be important, and without it, borrowing costs would go up. And when you have so much debt, even higher debt interest payments would be a big headache for the US government. Now, one final difference with 2022 is that today oil prices are actually going down quite a lot. They've plummeted on the prospects of a global trade war and lower global economic growth. So this will definitely reduce inflationary pressure, make the Federal Reserve's job a little bit easier. But also, oil prices have fallen so much, it will hit the US oil and gas industry. Interestingly, a big difference for the productivity between the UK and US was actually related to the oil industry. And this continued low price of oil could cause a recession in the US shale oil industry, which is quite expensive to produce. Now, the tariffs almost certainly won't stay at the current level, but there's going to be some major disruption. From an economic perspective, you could say it's a pretty interesting economic experiment. But what about the stock market after the worst start to the year for many decades? Is it a good time to buy now, or has the market failed to really price in some of the coming bad news? Well, thanks for watching, and hope you don't run out of too many things in your shop, and more videos will be coming soon.